Markets do not move in one direction indefinitely. After a sustained trend, the price eventually exhausts its momentum and shifts. Many retail traders lose capital by attempting to buy into a falling market while the downward momentum is still at its peak, often entering well before the trend has actually stopped. Identifying a high-probability turning point involves waiting for a specific structural blueprint to form on the chart, which signals that the balance of power is changing. Our objective today is to build a confirmed reversal trade plan using a systematic approach on a live charting platform. This construction requires two foundational elements: a standard candlestick chart to track price action, and pre-identified zones of support and resistance. You will also need a momentum oscillator, specifically the RSI or the MACD, to act as a secondary filter. Establishing these objective tools in advance provides a clear checklist to follow, which helps prevent reactive decision-making when the market becomes volatile. The first requirement for this setup is a clearly established continuous downward trend. We look for the exhaustion zone, where this falling price action collides with a significant, previously identified support level. This collision indicates that the sellers who were driving the price lower are beginning to run out of momentum as they hit a wall of historical buying interest. Attempting a reversal trade on an empty chart, away from these key structural levels, is one of the most common causes of trade failure. For a reversal signal to be valid, it must occur directly at a major structural boundary, where the market has shown a historical tendency to react. Once the price enters the support zone, we shift our focus from the macro trend to the micro interaction of the individual candlesticks. We are searching for specific patterns, like the hammer candle, which is identified by a small upper body and a disproportionately long lower wick. That long wick shows that sellers tried to push the price lower during the session, but buyers regained control and pushed the price back up before the candle closed. Alternatively, look for a bullish engulfing pattern. Here, a large green candle completely covers the range of the previous red candle, signaling an immediate shift in control. Spotting these candles at a support zone provides the first physical evidence that the transfer of control from sellers to buyers is underway. However, trading a candlestick pattern in isolation is often a trap. We need a way to confirm that the internal momentum supports the visual signal. We use divergence as a mathematical filter to confirm that the selling pressure is actually fading, even if the price is still dropping. On your chart, look at the two most recent low points in the price action. In this example, the price action is making consecutive lower lows, suggesting the downtrend is still intact on the surface. Now look at your RSI indicator. At the exact same time the price hit those lower lows, the indicator made higher lows. This trajectory tells us that while the price is falling, the actual strength behind the sellers is weakening, creating a contradiction between price and momentum. When you align price structure with this momentum divergence, you significantly reduce the likelihood of being caught in a false reversal. The final error to avoid is entering the trade too early, before the reversal has been technically triggered by the market. Place your entry trigger just above the high of your reversal candle. By waiting for the price to break this level, you ensure that the market has enough bullish momentum to overcome the previous high. To protect your capital, place a stop loss strictly below the lowest point of the reversal candle's wick. If the market drops below this red line, the structural premise of the trade is no longer valid, allowing you to exit with a small, predetermined loss. This completed architecture shows how each component, the support zone, the candle pattern, and the momentum divergence, work together as a single trade system. This same logic is applied to sell setups by looking for an uptrend hitting resistance, a bearish engulfing candle, and bearish divergence. Following this framework replaces speculation with a repeatable process for evaluating market turns. Identifying these exhaustion points allows for trade entries based on observable market behavior and verified shifts in momentum.